The world of energy is rarely still. Today, in May 2025, we are witnessing a significant tremor in this landscape. Recent United States tariffs are disrupting the flow of American oil to some of its oldest and closest allies. This disruption is creating openings for other major players on the global stage. Traditional partners are reconsidering their energy sources, looking towards China and Russia. These nations are positioning themselves as alternative suppliers ready to fill gaps in the market. U.S. oil exports to key allied nations are facing a downturn, even as overall American oil production breaks records. The destination of U.S. oil is changing, altering long-standing energy partnerships. The implications touch upon economic stability, national security, and the global balance of power. We are seeing the early stages of a potential realignment in global energy supply. This situation demands scrutiny. What specific tariffs are involved? How deeply are they affecting U.S. oil exports to allied countries? How are China and Russia capitalizing on this moment? The answers involve understanding intricate market dynamics and recognizing geopolitical chess moves. The story of U.S. oil exports in 2024 and early 2025 could redefine alliances for years to come. It is a curious case, this American oil situation. The United States is an undisputed energy titan. Crude oil production figures for 2024 tell a story of remarkable success. Output rose by 2.5%, reaching a record 13.3 million barrels per day. Yet this narrative of success runs parallel to a more troubling one. The central theme is the reported crash in U.S. oil exports to its traditional allies. If tariffs make U.S. oil too expensive for allies, they will naturally seek more affordable alternatives. To understand the shifting currents, we must examine the available data from 2024 and early 2025. While overall U.S. export volumes are robust, the critical question is the destination of these exports. Tariffs have made U.S. oil less attractive to its allies. Pinpointing this specific decline within the broader export success requires careful analysis. The provided research highlights disruptions being reported. This suggests a complex picture where aggregate success might mask underlying shifts in trade relationships. The U.S. has actively reduced its own reliance on some foreign oil. Imports from Saudi Arabia plummeted to just 0.34 million barrels per day in 2024. Imports from OPEC nations overall also decreased. This internal shift could indirectly influence export priorities and relationships. The narrative of allies turning elsewhere gains traction when we observe proactive moves by nations like China and Russia. If U.S. tariffs create a price disadvantage for some allied nations, they would logically explore alternatives. Russia, for example, successfully redirected its fossil fuel exports. In December 2024, China, Turkey, India, and even the EU remained significant buyers of Russian energy resources. The crash in U.S. oil exports to allies might not be a sudden collapse, but a gradual erosion of market share. The full impact of these shifts is likely still unfolding. The imposition of tariffs can be a double-edged sword. If U.S. oil becomes significantly more expensive for allied nations due to these new tariffs, it is only natural for those allies to explore other avenues. Energy security is paramount for any nation. Governments will prioritize stable and affordable supplies to keep their economies running. The search for alternative suppliers is not merely a theoretical exercise. The global energy market is dynamic, with multiple producers eager to sell. Reports suggest that traditional allies of the United States are indeed looking towards new horizons for their oil imports. This is a response to economic realities created by trade policies. China and Russia are frequently cited as the primary beneficiaries of this shift. Russia has proven adept at redirecting its energy exports. Countries like India and Turkey have substantially increased their intake of Russian fossil fuels. China has also become a primary destination for Russian oil and gas. This situation creates a complex dilemma for U.S. foreign policy. China's role in the evolving global energy market cannot be overstated. As the world's second-largest economy, its demand for oil is colossal and ever-growing. Beijing's energy strategy focuses on securing diverse and reliable supplies. In a world where U.S. tariffs might be making American oil less accessible, China is well-positioned to absorb supplies from various sources. The data from late 2024 illustrates China's importance as an energy importer. It became the largest single buyer of Russian fossil fuels, accounting for 37% of Russia's monthly export earnings in December 2024. This deepening energy relationship with Russia offers China insulation from geopolitical pressures elsewhere. Beyond Russia, China has also been a key destination for Iranian oil. By early 2025, Iran had managed to increase its oil exports to around 1.65 million barrels per day, a significant portion heading to China. This demonstrates China's willingness to engage with sanctioned states to meet its energy needs. The implications of China's energy strategy are profound. If U.S. allies are turning away from American oil due to tariffs, and China is strengthening its energy ties with Russia and Iran, it contributes to a multipolar energy world. China's ability to secure vast quantities of oil enhances its economic resilience and geopolitical leverage. Russia's oil trade remains robust despite sanctions, redirecting exports to Asia. China and India are major buyers, with Turkey increasing imports. A shadow fleet transports much of Russia's oil. Despite a drop in volume, revenues rose by 6%. The shifts in global oil trade, reportedly spurred by U.S. tariffs, carry significant economic consequences. These ripples are felt by the major players and the global economy as a whole. Energy is the lifeblood of modern economies. Any disruption can have far-reaching impacts on inflation, industrial production, and consumer spending. For the United States, the picture is mixed. While record overall production and exports suggest a booming domestic industry, the potential loss of market share among traditional allies could have long-term economic downsides. Losing stable, high-value markets could impact the profitability of U.S. energy companies. For U.S. allies, if tariffs make American oil more expensive, they face a choice: absorb the higher costs or seek cheaper alternatives. Turning to suppliers like Russia might offer short-term price relief, but could also introduce new vulnerabilities. This diversification involves navigating a complex web of risks and rewards. Globally, these altered energy ties can contribute to market uncertainty. The increased reliance on shadow tankers for Russian oil introduces risks of spills and disruptions. The potential for Iranian oil to flood the market could depress prices significantly. Such price swings make long-term investment planning difficult for all nations. The interconnected and sensitive global economic fabric is impacted by these energy realignments. The changes in global oil flows are actively reshaping the geopolitical landscape. Energy has always been a critical component of international power and influence. When the roots and sources of this vital resource shift, so too does the balance of power. Traditional alliances can be strained, new partnerships forged, and the global stage reconfigured. The reported tendency of U.S. allies to seek alternative oil suppliers in response to American tariffs could weaken long-standing partnerships. If these allies perceive U.S. trade policy as detrimental to their energy security, it may lead to a broader reassessment of their strategic alignments. This environment appears to be strengthening the ties between nations like Russia and China. Their deepening energy cooperation is a clear geopolitical statement. India's increased intake of Russian oil also signals a multipolar approach to foreign policy. These evolving relationships are creating new axes of influence in global energy governance. The United States finds itself at a complex juncture. Its status as a leading energy producer gives it considerable leverage. However, policies such as tariffs could undermine broader U.S. foreign policy goals. The contours of energy power drawn in 2024 and early 2025 may define international relations for decades. As we stand in May 2025, the global energy landscape is in flux. The interplay of U.S. tariffs, record American production, and the strategic export maneuvers of Russia and China presents a complex web of challenges and opportunities. Looking ahead, several potential trends and policy considerations emerge for the United States and its allies. The decisions made now will likely shape the future of energy security and international relations. One key question is the sustainability and long-term impact of the current U.S. tariff policies on oil exports. If U.S. allies continue diversifying their energy sources, Washington may face a policy dilemma. It could choose to maintain its current tariff structures or revisit these tariffs. Future trends could also be influenced by the actions of other major players. Russia will likely continue its efforts to circumvent sanctions and secure markets for its oil. China's demand for energy will remain a dominant factor. The situation with Iranian oil also remains a wild card. Recommendations for U.S. policy might include a more nuanced approach to trade measures. Enhanced diplomatic engagement with allies on energy security matters could be crucial. Navigating this new energy era will require foresight, adaptability, and a clear understanding that energy policy is linked to broader geopolitical strategy.